We are Group T, and we're going to be presenting Chapter 14, Mutual Funds, an Easy Way to Diversify. Today's presenters are me, Gabi Bubalis.
Victoria Lakerman.
Nick Paolo.
And Emiliano Sosa.
The learning objectives of our presentation are to weigh the advantages and disadvantages of investing in mutual funds, differentiate between types of mutual funds, ETFs, and investment trusts, calculate mutual fund returns, classify mutual funds according to their objectives, and selecting a mutual fund that's right for you. So first off, what is a mutual fund? A mutual fund is an investment that raises capital from investors, pools the money, and then invests it in stocks, bonds, and other investments. In shorter terms, it's a way of holding investments such as stocks and bonds in a diversified portfolio that are professionally managed. And each investor owns a share of the fund proportionate to his or her investment. So the pros and cons of a mutual fund include the advantages of diversification, professional management, minimal transaction costs, liquidity, flexibility, service, and the avoidance of bad brokers. However, the advantages do include a lower than market performance, the costs, the risks, the fact you cannot diversify away a market crash, and the taxes. Continuing on the pros and cons, on the right, you'll see a breakdown of a large mutual funds and their diversification into different market sectors, which helps with diversifying away risk. And then on the left, we have the cons of the failure of active management, showing that a majority of these public funds are failing to beat the index. So mutual fund structure and operations. A mutual fund pools money from different investors with similar financial goals, outlined with clearly stated investment objectives, which are followed and paired with set goals. In terms of ownership and management, mutual funds are structured as corporations or trusts, with shareholders electing a board of directors to oversee the fund operations. A management company then runs the fund and makes the investment decisions, and each mutual fund hires a professional investment advisor to oversee the portfolio. And here you see a figure just kind of visually showing the flow of investors investing their savings in the fund and the fund investing then that capital into a wide range of stocks and bonds. So how funds are generated, there is value growth, which as the value of securities in the mutual fund increases, so does the value of each mutual fund share. The source of returns, dividends or interest payments to shareholders or capital gains distributions when the fund actually sells a security at profit. And the reinvestment option, which is that many mutual funds allow for the automatic reinvestment of earnings, increasing the number of shares an investor owns over time.
All right, let's start with one of the most common types of investment companies, the open-end mutual fund. These funds are unique because they can issue an unlimited amount of ownership shares. That flexibility makes them very accessible for investors. The dollar value of each share is known as the net asset value, or NAV. To calculate NAV, subtract the fund's liabilities from the total market value of its securities and then divide that by the number of shares outstanding. For example, if a fund has 850 million in assets, 50 million in liabilities, and 40 million shares, the NAV would be $20 a share. This is a key measure because it tells investors how much one share of the fund is worth. Not all investment companies work the same way. A closed-end investment company cannot issue new shares after its initial offering. That means the number of shares is fixed, and they're typically bought and sold on the open market like stocks. Another type is the unit investment trust, which holds a fixed pool of securities, often municipal bonds, until they mature. These trusts are a good option for diversification because they let investors access a mix of securities without buying each one individually. However, they aren't ideal for short-term goals. If your time horizon is less than 10 years, you're going to be generally better off avoiding them. Next, we have REITs, real estate investment trusts. These are similar to mutual funds, but every investment in a REIT portfolio involves real estate. By law, at least 75% of their income must come from real estate, and 95% of that income must be paid out to investors as dividends. REITs can be a smart way to invest in real estate because they're much more liquid than owning property directly. Be cautious though, real estate markets can be volatile. There's three types of REITs. Number one is equity REITs, which are going to buy and manage property directly. Investors benefit when the property appreciates. And then mortgage REITs invest in mortgage loans. They pay out interest income, but offer little in the way of capital growth. Hybrid REITs combine both strategies, owning property and investing in mortgages for a balance of growth and income. All right, and this chart's just comparing the average annualized returns of equity REITs in the broad stock market as the Russell 3000 index over rolling 10-year periods. So the green line is showing REIT performance, and the gray line shows the overall stock market. You can see that REITs are often performing similarly to the stock market. In some periods, they're actually doing better, but times like you can see the 2008 financial crisis, REITs took a hard hit. This is emphasizing how important it is to understand the market cycles and diversify your investments. REITs are going to offer you strong potential returns, but like any investment, they come with risks. All right. When investing in mutual funds, you must understand whether the fund is a load or a non-load fund. Load is just another word for commission. With load funds, you either pay a fee upfront called a front-end load, or when you sell, known as a back-end load. Mutual funds are also divided into three share classes. Class A is going to have front-end loads. Class B shares come with back-end loads that decrease over time. And Class C shares typically don't have large commissions, but they carry the highest annual fees. Your choice depends on how long you plan to hold the fund and how much you're investing. Beyond commissions, there's also ongoing fees. One other cost is the expense ratio, which is going to be the percentage of a fund's assets that goes, towards expenses. It usually ranges from 0.05% to 2%. And, obviously you're going to want to invest in funds with lower expense ratios. Another metric to watch for, turnover rate. It's going to tell you how frequently a fund buys and sells assets. The higher the turnover, the higher the trading costs. Finally, there's also the 12b-1 fee. This is a marketing fee that ranges from 0.25 to 1%, and it's just going to be used to promote the fund. All right, let's look at how to calculate mutual fund returns. These come from three sources: dividends, capital gains, and changes in net asset value. To calculate the total return, we use the formula dividends plus capital gains plus ending NAV minus beginning NAV, all divided by the beginning NAV. Looking at this example here, the beginning NAV here is 1945. The ending is 23.59. Dividends are 60 cents and capital gains are 47 cents. So the return would be 60 cents plus 47 plus 4.14, all over 19.45, which is going to give you a return of about 26.79%. This formula is key when comparing different funds, especially those with similar investment strategies but different fees. Mutual funds come in many types, each with a specific investment objective. When choosing a fund, start by asking what your financial goal is: growth, income, or capital preservation. Don't go by the name, dig into the fund's holdings to understand what it actually invests in. Also, always examine the expenses. A fund with high fees will seriously eat into your returns. In general, the lower the expenses, the better the fund's going to be for you as an investor. Lastly, just covering money market mutual funds. These funds invest in ultra short-term debt instruments like treasury bills, CDs, and commercial paper, all with maturities under 30 days. They're generally considered very low risk, and they maintain a constant NAV of $1. That means you don't usually see price fluctuation, but returns are also lower. There are a couple types. There's tax-exempt money market funds focusing on short-term municipal debt, which can be useful for high-income investors trying to reduce taxable income. Government securities money market funds invest only in U.S. government debt and are also considered the safest of the bunch. And these are a good place to park cash if you're, just temporarily, or if you're trying to build an emergency fund.
I'm going to go over starting with the stock mutual funds. Stock funds invest primarily in common stock and are by far the most popular type of mutual fund, and they account for over half of all funds. And there's a lot of different types of stock mutual funds, starting out with aggressive growth funds. And these are funds that go for stocks whose prices could rise dramatically, and they look for stocks with high price to earnings ratio. And this also means that they can be very volatile since you're looking for the most growth possible. Next, small company growth funds. They're very similar to aggressive funds, but they limit their investments to small companies. And their goal is to uncover undiscovered companies with high future growth and invest in them. And in this chart, you can see how funds are typically invested in a stock mutual fund. Here you can see it's 53% equity, 18% money market, 22% bonds, and 7% hybrid. Some other examples of stock mutual funds are growth funds, which pay more attention to strong firms that pay dividends. And this makes them less risky because the companies that they're investing in have strong reputations in the market, and they're typically more consistent in their returns than other companies. Next, growth and income funds aim to provide the investor with a steady stream of income, and they also look for well-established companies with strong dividends. But the difference between the growth funds and the income funds is that the growth and income funds are more focused on the income, which will be coming from the dividends. Sector funds generally invest at least 64% of its assets in a specific industry, and this makes them less diversified and more risky at times. For example, if during the 2008 financial crisis, certain sectors completely went down, like the banking sector. So if you had a mutual fund that invested in the banking sector, it it did not do well. And as you can see here, if a sector does well, your fund does well, and if a sector doesn't do well, your fund will also not do well. ESG funds are those that focus on environmental, social, and governance issues, and they avoid investments that are harmful to society. And they avoid investments in oil and tobacco products, and they've become a lot more popular recently. Index funds are funds that try to track a market index, and they have a low expense ratio. And an example of this would be the S&P 500, which invests in the top 500 largest companies in the US. And on average, they tend to be actively managed funds. And lastly, international funds, which concentrate its investments in securities from other countries. And two-thirds of the fund's assets must be invested outside the US. And it does not move perfectly with the US stock market. What this means is if that there's large fluctuations in the US stock market and you invest in an international fund, it won't be affected in the same way as the US stock market since you're investing from securities in other countries. Next, we go to balanced mutual funds, and they try to balance the objectives of long-term growth, income, and stability. And they hold both common stocks and bonds, and sometimes preferred stock. And these balanced funds are aimed at those needing income to live on and moderate stability in their investment, which makes them less volatile than stock mutual funds. And there's two types. A balanced fund can be equity oriented or debt oriented. And as you can see, if you have an equity oriented balanced fund, you're primarily investing in equity, stocks, and some debt and fixed income. And then a debt-oriented balanced fund will primarily invest in fixed income and some equity and stocks. Asset allocation funds invest in stocks, bonds, and money market securities, and they move money between stocks and bonds to outperform the market. And they're basically balanced funds that practice market timing. And here you can see an example of an asset allocation fund. You see they're basically just moving the money between their stocks and bonds, and these percentages are constantly changing, and it depends on how actively the mutual fund manager is running it. So these percentages could change day to day or quarterly or yearly. So life cycle and target retirement funds. These are mutual funds that try to tailor their holdings to investors' individual characteristics, such as age or risk, and they're based primarily on when you plan to retire. So you would meet with your advisor and talk to them about your investment goals and your age and how much risk you're willing to take on. And based on that, they'll create a life cycle and target or retirement fund for you. And here we can see that when you're young, you're primarily investing in the red US stocks because you want higher growth. And then as you get older, um, you lower your investments in US stocks and you start moving more towards fixed income, such as US nominal investment grade bonds and treasury protected securities. Because once you get older, you want less risk and you want to have more liquid assets that you're able to withdraw and plan your retirement on. Bond funds are mutual funds that invest primarily in bonds, and they fluctuate in value with market interest rates. And they're used for small amounts of money to keep investments liquid. And if you, the reason you do small amounts of money is because otherwise you would just use individual bonds, and since there is no professional management or fees. So because these bond funds have a lot of different bonds in them, you're allowed to withdraw your money more easily than a individual bond since you have to hold it to maturity. And these bond funds, sometimes you're able to withdraw before maturity. And some examples of companies that issue bond funds are Vanguard, American Funds, Fidelity Investments, Franklin Templeton Investments, Wells Fargo Advantage Funds, and Western Asset Funds. Next, we move on to U.S. government bond funds. They invest in securities issued by federal government or its agencies, and they fluctuate as interest rates move up and down. And they're primarily aimed at those who need a steady current income because they're less risky than other bond funds. And the type of bond fund maturities are short term is 1 to 5 years, intermediate term 5 to 10 years, and long term 10 to 30 years. And this is primarily based on your investment needs, how old you are, and how much risk you're willing to take on. If you're a young investor, you probably want to look at long-term U.S. government bond funds. And the older you get, you kind of want more short-term bonds. And the two types of government bond funds are municipal bond funds, which generally exempt from federal taxes. And the higher your tax rate, the more valuable municipal bonds have. Because if you're in a high tax bracket, you want to invest more money into municipal bond funds because you won't be taxed at the federal tax rate. And corporate bond funds. And some corporate bond funds tend to focus on high quality, highly rated bonds, and others focus on high yield corporate bond funds. And they focus on much lower rated and much riskier junk bonds, which can make it so it kind of depends on your investment needs again. If you want to just have a steady income stream with low risk, you want to go for the high quality, highly rated bonds. And then if you want to take up a bit more risks to hopefully earn higher return, you go for the high yield corporate bond funds. So next we move on to exchange traded funds, ETFs, which are a hybrid between a mutual fund and an individually traded stock or bond. And they trade on an exchange like individual securities do and can be bought and sold throughout the day. And they charge lower annual expenses and are more tax efficient than most mutual funds. Lastly, they allow investors to stake out an investment position in a sector, industry, or country. And here we can see an example of a dividend ETF, the iShares High Dividend Equity Fund. And you can see that they invest in different types of companies such as ExxonMobil, Johnson & Johnson, Procter & Gamble, Cisco, and much more. And the advantage you really get from ETFs is that you can buy and sell them throughout the day, unlike many other funds. And they're a way to diversify your portfolio, but you're only really investing in one stock technically. But it's a mix of all stocks put together.
Right. So just to explore ETFs and exchange traded funds a little bit more, like we had already said, they're becoming increasingly popular among both beginner and experienced investors. And to really drive home the main point, it's what sets ETF apart is that they combine the diversification of mutual funds with the real-time trading of individual stocks. So unlike mutual funds, which only trade at the end of the day, like we already said earlier, ETFs can be bought or sold throughout the day at market price, just like Apple or Amazon stock. And they're generally passively managed, which keeps annual fees lower than actively managed mutual funds. And this cost efficiency is one of the reasons why ETF has gained so much traction. And additionally, they're tax efficient. They're structured in a way that minimizes capital gains distributions, which means you might owe less in taxes compared to mutual funds with similar holdings. Another strength is flexibility. There are ETFs for nearly every sector, region, or investment strategy, from clean energy to tech to dividend focused or even commodity based ETFs. So, if you're someone who likes to tailor your portfolio to match your views or risk appetite, ETFs offer a ton of variety. Moving on to mutual fund services. This is where traditional mutual funds really shine in terms of investor support. They offer a broad range of convenience features that make managing your investment easier. First, there's automatic investment and withdrawal plans. This is great for building a habit of consistent investing or setting up systematic withdrawals during retirement. Most mutual funds also let you automatically reinvest your dividends or capital gains, helping you compound your returns over time without any extra effort. You can also get funds transfer features like wiring or funds express, plus online and phone-based switching if you want to adjust your portfolio. Then there are benefits for your retirement planning. Many funds offer simple IRA or Roth IRA startup options, along with check writing from certain types of accounts and detailed bookkeeping to make tax filing easier. So while ETFs offer more trading flexibility, mutual funds tend to offer a more complete service experience, especially for long-term investors looking for simplicity. Now going into the different steps of buying a mutual fund. When it comes to actually investing, the process starts with a bit of self-reflection. Step one is determining your goals. Why are you investing? What's your time frame? Are you saving for retirement, building wealth, or trying to generate income? You also need to evaluate your risk tolerance. Can you stomach a market dip without panic selling? Or do you want more stability even if it means slower growth? Additionally, you have to think about your tax situation. Are you investing through a taxable account or a tax deferred account like a 401k or an IRA? This can make a big difference in fund selection later on. So before you look at any specific fund, the key is to have clarity on what you're trying to achieve, because every other decision should align with that. Moving on to step 2 to 4, once your goals are more clear, you can move on to step 2, which is meeting your objectives. This is where you match different fund categories that you're trying to achieve. Do you want capital growth? You might lean towards a growth or index fund. Looking for safety and income, consider a bond or a balanced fund. Now moving on to step 3. Step 3 is selecting the actual fund. This is where due diligence really matters. Don't look at the fund name, read into the holdings. Compare performance over time, but don't chase past returns. Also, scrutinize the fees. A high expense ratio can really chip away at your long-term gains. And look at the manager tenure. Consistency and management can be a good sign of fund stability. Step 4 is making the purchase. Most people do this directly through the fund company's website or through a brokerage or mutual fund supermarket like Fidelity or Charles Schwab. These platforms let you compare mutual fund families in one place. So really, buying a fund is the final and easiest step. The heavy lifting is done in defining your goals and aligning them to the right fund. Now, the life cycle and target retirement funds. To wrap up this section, let's look at the life cycle and target retirement funds, which are perfect if you want to take a hands-off approach. These funds are structured to automatically adjust the asset allocation based on your expected retirement date. When you're younger, the fund holds more stocks for growth, and as you age, it shifts towards bonds and cash equivalents to reduce risk. That's what's great in these funds. What's great is that these funds provide built-in diversification and automatic rebalancing, so you don't have to consistently adjust things yourself. They're especially popular in employer retirement plans like 401ks because they simplify everything. All you do is pick your target year, like 2055 or 2060, and the fund does the rest. However, make sure the glide path and risk tolerance of the fund matches your personal comfort level because not all target date funds are created equal. In short, these are ideal if you want a set it and forget it option that still evolves with your life cycle.